I'm reminded how hard it is to commit to growth in the face of turbulence, uncertainty. But we need to maintain this growth mindset. In spite of that, growth creates value. We have to keep at it. The fog makes it challenging, but leaders need to make sure that we continue to find ways to make growth investments, to take growth risks. Welcome. I'm Tom Doorley of Sage Partners. I'll be your host today. My guest today is Barry Weiner. Barry heads the M&A research practice at Deloitte. I've known Barry for a long time. We worked together back in our days as strategy consultants at the Braxton division of Deloitte. Barry came to us from his time in the Air Force as an Air Force officer, and then his work at Tuck, where he got his MBA. Then he was with us and decided he wanted to be an entrepreneur, and went out and ran some companies and advised some companies. And finally, he came back to Deloitte, where he heads, as I said, the research arm of the M&A practice, which I know is a very important practice. Welcome, Barry.
Thank you so much, Tom. It's a pleasure to be back with you again, always.
Yeah, and this is our third time, so those sort of frequent flyer listeners would recognize you from times past.
God forbid.
As we start, we're going to talk about the M&A survey that you've just completed. Give us a little bit of the methodology so we have sort of the feeling that it's based on, obviously, which I know it is, good work.
For sure, Tom. Thanks so much for the question. The M&A survey, which increasingly we're taking to calling a data asset as opposed to a survey, and I'll explain why, relies on the responses of 1,500 private equity and corporate leaders. That sample is split about 60% corporate, 40% PE. The reason why I make the data asset comment is our analysis and the messages we'll be talking about today, the topics we'll be talking about today, are really based on three data sources. One is that rigorous survey, which we've just published. Another is proprietary M&A market data that we track on a very regular basis. And the third is some macroeconomic data, which is essentially important to the story.
Great. All right. So when we talked the other day, you described the fact that the way this unfolds best is working off four themes that you've developed. The first theme is that you see the people that you interviewed as being optimistic but cautious. Secondly, you talked about some signals that are aligned, some red, some yellow, but unfortunately aligned. We'll talk about that. Thirdly, we'll talk about, in spite of the confusion or sort of the changes going on, that there is a lot of opportunity. And finally, we'll talk about the pivots. And my guess is that's where we'll talk about the title of your survey, A Tale of Two Markets. So Barry, let's start there at the beginning. And let me ask you a question. But you see these 1,500 people that you interviewed as being optimistic, which you expected, but simultaneously cautious.
Yeah, exactly, Tom. It's important to also note in terms of the survey particulars that the 1,500, besides being corporate and private equity, are particularly senior and from the largest private equity funds and the largest corporations in the country and to some degree the world. So that's important. But the optimism point is really de rigueur. When we look across the last 15 years and you ask M&A leaders whether they're optimistic about the year ahead, and we ask that question in terms of, do you expect to do more or fewer deals in the next year? Do you expect these deals to be larger or smaller in size in the next year? That's how we typically ask the questions. Always, Tom, always 80% plus are optimistic that the answer will be, yes, it'll increase. Coming into this year, when we asked those questions, we realized we had to get a little bit more sophisticated, because if you give them the choice of, are you optimistic or pessimistic, M&A leaders, like business leaders more broadly, are an optimistic lot. So what we did is we created 5-point Likert scale a few years ago. And by using 5 points, we can see shifts in between those that choose not just increase versus decrease, for example, but who would choose between significantly increase and somewhat increase. And sure enough, when we looked at that for this year, coming around the bend into 2026, there was a 17% fall off from prior years in terms of those that chose significantly increase in the volume and value categories versus those that took the more cautious position of somewhat increase. So they're not going to go big time into the pessimism of it's all going to decrease and collapse. No one really says that. But the difference there was stark. To put that into context, that 17% drop is relative to a typical 1 or 2% drop or increase. Wow. So it really stuck out to us. Cautious optimism in numbers.
Yeah. So I'm a member of a panel that's run by CEO Magazine that asks, what do you think about things going forward? And in general, for the last 3 months, it's done monthly, it's been fairly flat. Increased just a little bit, but fairly flat. And the important thing is, so they haven't turned pessimistic, but it's still well below where it has been in the past when things are on fire. So I think your cautious optimism is underscored by that survey and by other surveys as well, by my own conversations with the C-suite. So let's not talk about the second question. Yes, let's talk about the second question, or the second point of emphasis. And that is this idea that you see signals which are aligning. And you've called them mostly yellows and reds, right?
Yes.
Go ahead.
Yeah. Signals, we're talking about these three different buckets of metrics that we look at regularly. So there's the survey data, there's the M&A market data, and there's the macroeconomic data. So when you're talking about a topic like mergers and acquisitions and divestitures, for that matter, and other types of alliances, the measures that matter are things like monetary policy, for example. So monetary policy, as measurable by the Fed funds rate that the U.S. Fed decides on a monthly or bi-monthly basis, as most people know who follow the economy, last year in the third and fourth quarter, the Fed decided to ease rates 3 times, each time 25 basis points. Mm-hmm. That's a good thing for M&A, because as debt gets cheaper, debt is used to finance deals. So that's a tailwind. That's a good thing. That would be a green flag, if you will. The yellow caution on that particular metric is they've been in pause mode now for about 5 months. So coming into 2026, there's been no more activity in terms of Fed interest rate reductions. And even now, Tom, we have to be very vigilant, because depending on what happens with inflation, another metric that we're looking at very closely and is uncertain at this point where that's going, when you look at that, it's very possible for the first time we have credible experts that believe it's conceivable the Fed could actually tighten and raise rates later in the year. If they were to do that, that would be bad news for the economy. Well, not for the economy, in different ways it would be bad, but certainly bad for M&A. So that's an example of two metrics that we look at. From an M&A market, I'll give you one more. From an M&A market data perspective, the first quarter, we just closed the books on it on March 31st. There was about a 4 to 5% decline in the number of deals done in this first quarter, 2026, relative to Q1 in the prior year, and an even more pronounced decline Q1 this year versus Q4 next year. The value number, which is the less reliable way to measure M&A activity, but nevertheless an important one, there always are these iconic or mega deals that will get done in any kind of economy. And we had a good number of those in the first quarter. So the value trend line held. The volume trend line continues to decline, which has been a 5-6 year trend now.
Yeah. Okay. So that gives us context of sort of the idea of caution. But let's talk about now why you think this is a good time for M&A. Why companies should be opportunistic in seeing those opportunities there. I give you sort of a thing that says that when we're doing our work here, we're calling it the fog of change. And
Yes.
in the fog of change, it says there's all kinds of things going on that are confusing. And sort of a natural tendency might be to sort of pull back a little bit. But
Yes.
but that's wrong. That's wrong. We have to recognize that if you only worry about the danger, then you're going to miss the opportunities. This is a great time to, in M&A, buy things at somewhat of a discounted price. Still not cheap, but lesser than perhaps they were. In general, it is a time to be continuing to go forward. Would you agree with that?
Strongly, Tom, strongly. We're going to be talking about a number of opportunities for deal makers as the conversation unfolds, but the biggest single opportunity actually is the prompt or the impetus for our title, A Tale of Two Markets. Why is that? Because of what you just said. And also what I was describing from a metrics perspective just before what you talked about. So when you have the number of deals in steady but measured decline, at the same time, the overall value of deals in the United States has held and gone up even at times. What that tells us is that for those acquirers that can do the mega deals, the deals more than 5 billion, 10 billion in size, which is a minority of American companies and private equity funds. But for those that can do it, the opportunities will always be there. These transformative deals. We've had a couple announcements even in the last month, and I can't name them here, but we all know them. But when you have that value spike and the volume or the number of deals is flat or declining, and we looked at this very analytically and very rigorously, what that tells you is there are two markets that have been relatively ignored now for a few years. And that is the medium-sized companies and the smaller companies from a targeting perspective. So while all acquirers are aware these markets can be segmented that way, that's not news. What is news is that we know from that downward volume trend, that downward number of deals trend, that there just hasn't been as much emphasis on the smaller and medium segments of the market. So we are saying very strongly from a perspective of Deloitte M&A US that all clients, irrespective of their size, irrespective of whether they are PE or corporate, would do well now to not put their foot on the gas, not be hesitant, not pause, which is very natural for humans to do this at times like these with the geopolitical tensions and everything else. To your point, they actually should resist that tendency and get into the market and look for value that would not have been gettable, so to speak, not realizable, not exploitable in recent years. We used to have so many conversations with clients about elevated valuations on potential targets. We're not hearing that anymore. Now, for the bold and leading M&A organizations, getting into the market for those bolt-on deals, those gap-filling deals, makes a ton of sense because it's less competitive, because the valuations have come down a little bit, bid-ask spreads narrow, and there's just a lot of good reasons why this is the time to act, because the returns can be had, the value realization can be had, the synergies can be had. That's
And
opportunity number one. That's a tale of two markets.
Sorry, right? Yeah, you said in our conversation the other day that one of the data you looked at is the bid versus ask ratio, and that is a pretty fundamental and I think a logical explanation for what you're saying. Explain that.
Yeah, bid-ask spread basically is for people who may listen to this webinar later who are not business people or not M&A people.
Right.
A bid-ask spread refers technically to the difference between what's offered for a company versus what is requested for the value of a company. In plainer English, Tom, it's just whether buyers and sellers can agree.
Right.
So in a hot market where valuations are elevated on some of those better quality companies that are available for potential acquisition, it can be more difficult for a private equity buyer or a large corporation that's Fortune 50 to reach an agreement with a seller who believes their value is much higher than the acquirer does. However, when you have a softer market, a calmer market, as we see now, that's an opportunity to come in and a good quality prospect may not be getting as much action, may not be getting as much attention. And for an acquirer, that's opportunity. Again, a reason why they should act.
Absolutely. Now let's not talk about then the sectors where you see this opportunity. The one thing that I'm struck by is I happen to hear a couple of different interviews that Jamie Dimon has done. And Dimon is very optimistic, by the way. He sees incredible amount of opportunity. And he's talking about investing, as JP Morgan Chase, $1.5 trillion over the next decade. It's going to go into the industrials, not so much software, but it's going to go into infrastructure. It's going to go into transportation. It's going to go into stuff like that. Boy, that screams opportunity to me.
There's no doubt about it. To put that into context, Tom, that 1.5 trillion number that you just mentioned, the total aggregate value of deals in the United States from year to year, looking back across 10, 15 years, is typically between 1.5 and 2 trillion. So that's quite a large number to put that into context, right? But yes, we think there is going to be opportunity, and there will be transformative deal opportunity, large deal opportunity, and there will be even more, we believe, small and medium-sized deal opportunity. But in terms of sectors, your question, certain sectors certainly will see more action than others. Certainly life sciences, healthcare is an industry we're paying close attention to. These are more resilient sectors typically, even if there is a recession, even if there is inflation rising, these other factors. Another area, of course, is technology and high tech. AI is a transformative force for the world. There's no doubt about that. And we're seeing more deal activity around AI companies and AI-enabled companies. So we expect that to happen as well. Then you have sort of the non-discretionary sectors, whether that's the FMCG part of consumer or transportation or energy. Energy, of course, for those that know a little bit about AI, is really the foundation upon which AI sits. That's the data centers, which draw tremendously from our power grid. So energy companies figure to do very well. And there's also consolidation there, which is about M&A as well, opportunities and asset acquisitions as well.
Yeah, and one of the things we see with AI is that companies are trying to get in and buy the young companies sooner than they were.
Yes.
You're making a bet. Is this one going to work or not? And many of them won't work. But the longer you wait, the higher the value goes. And so this goes to your point about smaller, medium-sized deals. They're saying, okay, we're going to bet on 3 of them, right?
Right.
That are smaller companies as opposed to one that's already proven itself.
Yeah, absolutely, Tom. There's 2 things that are a little bit unusual, but we think they're the beginning of trends, for example, building onto your point. One is that if you look at some of the biggest AI companies out there, increasingly we're seeing some of those companies make acquisition of assets or make significant investments in some of their key partners or customers. And that's a little bit atypical. It's a little bit atypical. Another thing that's a little bit unusual or a little bit anomalous, so to speak, is the idea that you have some companies that are not tech companies themselves making acquisitions of small, early stage tech and AI companies.
Right. Right.
Not your grandfather's M&A, so to speak.
No, and we're seeing that. So let's talk others about the dynamics. Where else do you see it being a dynamic market? One of the things you said last year was with the economic uncertainty that the idea was sort of more investment close to home, not so much reaching out to developing economies, but rather in terms of established economies and maybe even more in the home market. Do you see that happening as well?
It's interesting, Tom. There's a few different areas that figure to be dynamic and present greater opportunity. And the one that you just mentioned, which we call cross-border deal making, international deals, as it were. In 2025, that really declined precipitously in a way that it doesn't normally. U.S. acquirers pulled back significantly on their targeting and acquisition of overseas companies, wherever it was, whether it was developed market or undeveloped market. We think given that, there's probably going to be opportunity internationally in very carefully chosen markets with quality assets, quality targets. We're actually doing some new work on that. We'll be publishing a new paper on cross-border activity specifically in early June, so people that follow us can look for that. However, beyond that, there's a couple other areas that figure to be very dynamic. One is around deal financing, for example. It's always been true, and certainly since the pandemic, that most deals tend to be financed with debt, but we've seen a major transition in recent years between commercial debt and private debt. Private debt or private credit is much in the news now for reasons that are unfortunate. I can talk about that separately if you want, but basically financing is changing in terms of deals and how they get funded, how they get financed. So more private credit, less commercial credit. Much in 2025, much more cash and much more equity. Equity is an interesting part of it because equity has been rising significantly in 2025 because of the equity markets. But now we see our equity markets, the NASDAQ, the S&P 500, declining and going into correction territory. So that will change the game yet again. That's just a financing point.
And so how worried should an acquirer be about the stability of the private credit market?
We would say you have to have, a wider scope on that question, right? How worried should they be? We're not sure they should be very worried, but certainly they should be vigilant. Much of what's written about the private credit markets is about default risk. Worries that there could be default risk because the vetting is obviously different for a private lender than it is for a commercial bank. However, at the same time, some of the largest private credit players have withdrawal limits on how much can be withdrawn by the institutional partners that fund these private credit funds that are used to make such loans. We think the bigger issue is going to be around liquidity. If you're a borrower or if you're a funder and you want to withdraw some of your funds that you've invested into a private credit fund, you can't really do that as much as you might want to do. So from a liquidity perspective, you have to look at other funding pools. That's one difference for sure. We expect there to be some bumps in certain sectors, but it'll be more a sector by sector situation or a company by company.
Yeah. So each year, Barry, I download and save, which I have done this year, the work that you've done in the survey. Tell everybody how it is they would get their own copy of what I think is a great piece of work.
Sure. No, thank you so much, Tom. Obviously, the work comes out under the umbrella of Deloitte US. On Deloitte.com, the main website, you can just click on services. It will bring up M&A and restructuring services. Click on that, and this study will come up as the homepage, and you can download a PDF or even listen to a webinar that we did very recently. Alternatively, anybody's welcome to reach out to me on LinkedIn. I'll connect with anyone that watches this teleconference and wants to do that. Happy to do that. And some of the materials are also available on my own LinkedIn, and it can get there as well.
And the title that I'd be looking for is A Tale of Two Markets, right?
Indeed. The 2026 Trend Survey, A Tale of Two Markets, A Tale of Two Markets. The two markets being those mega deals versus the smaller segments.
That's right. So as we're in kind of closing here, Barry, I always ask my guests to say, is there some sort of message you want to deliver to the people who've happened into our conversation? Something you'd like to say?
Absolutely, Tom. I guess I would say this to all listeners who would listen to this in the months ahead. We talk a lot and think about a lot about rowing against the tide, not going with the herd. Um, this is a time for that, we believe, for deal making. But I'll make an analogy which serves very well, I think, which is to personal investing. It's almost a cliche in personal investing. If you're teaching a young person how to think about the stock market, this notion of time in the market versus trying to time the market. Mm-hmm. That is analogous with M&A. This is a time to realize value that was not as true a couple of years ago. But the natural inclination is to pause, is to be hesitant, to worry about the war, the oil shock, the potential inflation risk, the interest rate trend. That's the wrong way to react to this. Some of the greatest returns 3 years from now, we believe, will be realized based on investments made in 2026. And in fact, 3 days ago, when we did a webinar on this material for about 4,000 clients, we got some inbound messages from people in Europe and Asia who were telling their own stories about how the last time there was a context like this, a geopolitical reality like this, their private equity fund, their company realized some of the biggest ROI on an M&A acquisition or a private equity investment of the last 50 years. So we think this is an unusual time that way.
I like that story, Barry, because that's exactly the message we're trying to deliver in terms of helping people understand how to navigate the fog of change. At a time like this, wow, market shares are up for grabs. Customers are looking for new works. Values have changes, and it's just such a wonderful time if you have the grit, if you have the resilience, if you have the ability to go out and do it, to make a move. No question.
Absolutely. Volatility represents opportunity.
It does. So thank you all for listening to Barry and myself. I look forward to our next conversation. Until then, take care and be well. Change has never come faster or hit us harder. In the fog, leadership is the light that cuts through. I'm Tom Doorley. Thanks for joining me on our Focus on Growth, Navigating the Fog of Change series. Until the next time, keep leading forward.